Let me ask you one question. Why do some people who earn millions still end up broke? And why do others with average incomes quietly build life-changing wealth? The answer isn't intelligence. It isn't luck. It isn't even opportunity. It's psychology. Welcome to the Psychology of Money audiobook summary, inspired by the powerful lessons of Morgan Housel. In this series, you'll learn why behavior matters more than knowledge, how emotions secretly control your investments, why patience creates real wealth, and how to think differently about money forever. If you want financial freedom, not just income, you're in the right place. But quick favor before we start. Backhand index pointing right, subscribe right now. Backhand index pointing right, like this video. Backhand index pointing right, comment long-term wealth below. Because this isn't just another finance video. This is a mindset shift. Let's begin. Money. A word that seems simple. 4 letters. Counted in numbers. Stored in accounts. Displayed in statements. But behind those numbers lies something far more powerful. Emotion. Most people believe that money decisions are mathematical. They assume that investing, saving, spending, it's all about formulas, charts, percentages, and returns. But that belief is one of the biggest financial illusions. Because money decisions are not made in spreadsheets. They are made in hearts, in memories, in fears, in childhood experiences. And until you understand that, you will never truly understand money. The illusion of rational thinking. Imagine 2 people. Both earn the same salary. Both live in the same city. Both have access to the same financial information. Yet one invests aggressively in stocks. The other keeps all savings in cash. Who is right? From a mathematical standpoint, you might argue that the investor is smarter. Historically, equities outperform cash. But from a psychological standpoint, both may be perfectly logical. Because money decisions are shaped by personal history. If someone grew up watching their parents lose everything in a market crash, cash feels safe. If someone grew up watching investments multiply over time, risk feels normal. Neither person is crazy. They are reacting to their experiences. And that is the first powerful truth. Financial behavior is driven more by emotion than intelligence. The role of fear. Fear is the most powerful financial emotion, not greed. Fear. People say markets move because of greed. But greed only operates when fear is absent. The moment fear appears, logic disappears. During market crashes, intelligent investors panic. They sell at the worst possible time. They abandon long-term plans. Not because they don't understand compounding, but because emotionally, loss feels unbearable. Psychologists have discovered something powerful. Loss hurts almost twice as much as gain feels good. If you lose $1,000, the emotional pain is stronger than the happiness of gaining $1,000. That imbalance controls financial behavior. It explains panic selling. It explains conservative investing. It explains hesitation. Money is not about maximizing returns. It is about minimizing emotional pain. Childhood, your hidden financial blueprint. Close your eyes for a moment. Think about your childhood. What did your parents say about money? Money is hard to earn. We can't afford that. Rich people are greedy. Investing is risky. Or maybe, opportunities are everywhere. Money grows when invested. Taking risks is necessary. Those phrases were not just conversations. They were programming. By age 20, most people already have deeply rooted money beliefs. And those beliefs operate unconsciously. You may think you're making rational decisions, but often, you're protecting childhood fears. If your family struggled financially, you may oversave and underinvest. If your family was wealthy, you may feel comfortable taking risks. Neither is wrong, but both are emotional. Intelligence versus behavior. Some of the smartest people in the world lose money. Some average people build massive wealth. Why? Because finance is not an IQ test. It's a behavior test. Let's imagine two individuals. Person A, high IQ, constantly changes strategy, reacts to news, chases trends. Person B, average intelligence, invests consistently, ignores noise, stays patient. After 30 years, Person B usually wins. Because wealth building rewards consistency, not brilliance. Brilliance creates complexity. Consistency creates compounding. And consistency requires emotional stability. Emotional stability, the real superpower. Markets go up. Markets go down. Economies expand. Economies collapse. You cannot control those cycles, but you can control your reaction. The investor who remains calm during chaos has an advantage that no algorithm can replicate. Emotional stability is not about ignoring fear. It's about accepting volatility as normal. Most people enter investing believing markets should grow smoothly. When reality proves otherwise, they panic. But volatility is not a flaw. It is the price of admission. You cannot demand high returns without accepting uncertainty. And uncertainty is uncomfortable. The storytelling brain. Humans are storytellers. We do not process data objectively. We turn numbers into narratives. If the market drops 5%, we don't see 5% volatility. We see something is wrong. Recession is coming. I might lose everything. Stories amplify fear. Media amplifies stories. And emotional reactions follow. The danger is not the data. The danger is the narrative you attach to the data. Why timing feels so important. When markets rise, people feel smart. When markets fall, people feel foolish. This emotional roller coaster makes timing extremely tempting. If I just buy at the bottom and sell at the top. But timing requires prediction. Prediction requires certainty. And certainty in markets does not exist. Yet emotionally, we crave control. Trying to time markets is not about maximizing profit. It's about reducing anxiety. It gives the illusion of control. But illusions are expensive. Money as identity. Money is not just survival. It is identity. It signals success. It signals competence. It signals status. When someone's investments fail, it feels personal, not financial. That's why losses hurt so deeply. Because money becomes tied to self-worth. And when self-worth is involved, emotion takes over. The quiet power of boring behavior. The most powerful financial strategy is boring. Invest regularly. Diversify. Avoid extreme risk. Be patient. That's it. But boring strategies don't excite emotions. They don't create headlines. They don't create ego boosts. So people abandon them. They chase excitement. They chase stories. They chase quick wins. And emotions destroy compounding. Understanding yourself first. Before choosing stocks. Before choosing businesses. Before choosing strategies. You must choose yourself. Ask, how much volatility can I emotionally tolerate? How will I react if my portfolio drops 30%? Will I stay calm or panic? The best strategy is not the one with highest theoretical returns. It is the one you can stick with, because discipline beats perfection. Final reflection of Chapter 1. Money is not a math problem. It is a mirror. It reflects your fears, your ambitions, your insecurities, your patience, your ego. If you master the emotional side of money, the mathematical side becomes simple. But if you ignore emotions, no formula can save you. Because in the end, wealth is not built by the smartest. It is built by the most emotionally consistent. And that is where your journey begins. Before you ever earned your first salary, before you opened your first bank account, before you understood what investment even meant, your financial life had already begun. Not in numbers, not in spreadsheets, but in stories. Because long before we manage money, we absorb money, and we absorb it from the people around us. The invisible financial script. Every person carries an invisible script about money. A script that whispers, money is scarce. Money is power. Money is dangerous. Money solves everything. Rich people are lucky. Rich people are corrupt. These scripts are not written consciously. They are downloaded silently from childhood experiences. And most people never stop to question them. They simply live them. Your first memory of money. Think carefully. What is your earliest memory involving money? Was it your parents arguing about bills? Was it watching your father count cash carefully before paying rent? Was it seeing your mother refuse to buy something because it was too expensive? Or perhaps it was abundance. Maybe you saw shopping without hesitation. Maybe you saw investing conversations at dinner. Maybe you saw confidence around money. That memory matters, because it formed your emotional foundation. And emotional foundations are stronger than logic. The economy you grew up in. Your generation shapes your financial beliefs. Someone who grew up during economic crisis views money differently than someone who grew up during economic boom. If your teenage years happened during a recession, you may fear risk. If your early career happened during a stock market bull run, you may overestimate opportunity. Neither is stupidity. It's context. And context creates perception. Experience over education. You can read 100 finance books. You can understand every investment principle. But one strong personal experience can override all of it. If you saw someone lose everything in the stock market, no statistics will fully remove that fear. If you saw someone get rich from real estate, no data will convince you otherwise. Humans overweight personal experience. We trust what we see more than what we study. That's why two intelligent people can completely disagree about money and both believe they're right. Because they are defending their experiences. Money is local. The way someone in Karachi thinks about money may be completely different from someone in New York. Cost of living, job stability, inflation history, political stability. All of it shapes risk tolerance. If inflation has destroyed savings in your country before, you may distrust banks. If stock markets crashed repeatedly in your region, you may avoid equities. These are not irrational reactions. They are survival instincts. And survival instincts are powerful. The survival brain. Money activates the survival brain. The same brain that reacts to danger. When financial uncertainty appears, your body doesn't calmly calculate probability. It reacts as if survival is threatened. Because for thousands of years, resources meant survival. food, shelter, protection. Money became the modern version of resources. So when money feels threatened, your ancient brain reacts. And the ancient brain is emotional, not logical. Why advice often fails. Financial advice often assumes everyone starts from the same place. But no one does. When someone says, just invest long term, they're speaking from their emotional comfort zone. But if your story includes instability, long term may feel unsafe. That's why generic advice fails. Because it ignores your personal money story. Before following advice, you must understand your story. The generational gap. Older generations often criticize younger ones. You don't save enough. You take too many risks. Younger generations respond. You had easier opportunities. You don't understand modern costs. Both sides are right, because they lived different financial realities. House prices, education costs, job markets. Different environments create different behaviors. And each generation believes their approach is correct, because it worked in their context. The danger of copying others. One of the biggest financial mistakes is copying someone else's strategy without understanding their story. If someone built wealth through entrepreneurship, but you value stability, copying them may create stress. If someone invests aggressively because they have multiple income streams, and you have one unstable income, that strategy may not suit you. Your financial plan must match your psychology, not someone else's highlight reel. Trauma and money. Financial trauma is real. Losing a job suddenly, experiencing bankruptcy, watching a family business collapse. These events leave deep emotional marks. Sometimes people become extremely conservative afterward. Sometimes they swing to extreme risk-taking. Both reactions are emotional coping mechanisms. Healing your financial life sometimes requires healing your financial trauma, not spreadsheets. Self-awareness. Awareness, the turning point. The moment you recognize your money story, you gain power. Because unconscious patterns control behavior. But conscious awareness creates choice. Ask yourself, why do I fear investing? Why do I overspend when stressed? Why do I feel guilty spending on myself? Why do I equate money with success? Every answer traces back to your story. And once you see it, you can rewrite it. Writing a new script. Your childhood shaped your beliefs, but it does not have to control your future. You can keep the helpful parts and challenge the limiting ones. Maybe you learned discipline from scarcity. Keep that, but remove the fear. Maybe you learned ambition from abundance. Keep that, but remove arrogance. Financial maturity is not rejecting your story. It is refining it. The emotional audit exercise. Here's something powerful. Imagine you suddenly lost 30% of your investments. What emotion appears first? Fear? Anger? Shame? Denial? That first emotion reveals your money story. Now imagine your investments doubled. What emotion appears? Excitement? Greed? Overconfidence? Again, that reveals your psychology. Understanding these reactions is more important than predicting markets, because markets are uncertain, but your behavior determines outcomes. Stability versus growth. Some people prioritize stability. Others prioritize growth. Neither is wrong, but conflict happens when you try to live someone else's priority. If you crave stability but chase high-risk investments because others do, stress will follow. If you crave growth but hold excessive cash out of fear, regret will follow. Alignment between personality and strategy creates peace, and peace allows consistency. The long-term advantage. The greatest financial advantage is not information. It is behavior alignment. When your strategy matches your psychology, you stick with it. When you stick with it, compounding works. When compounding works, wealth builds quietly, not dramatically. Quietly. Final reflection. Chapter 2. Your financial future is not determined by the economy alone. It is shaped by your story, your memories, your fears, your early lessons, your generational context. Before mastering money, master your narrative. Because the person who understands their emotional blueprint has already won half the battle. And in the world of money, self-awareness is the ultimate edge. Chapter 3. No one is crazy about money. Have you ever looked at someone's financial decision and thought, how can they be so stupid? Why would someone buy an expensive car on loan? Why would someone keep all their money in cash? Why would someone invest everything in one risky idea? From the outside, it looks irrational, illogical, even reckless. But here is one of the most powerful truths in finance. No one is crazy. People make decisions that make sense to them, even if they don't make sense to you. Different lives, different logic. Imagine two individuals. One grew up in a stable household. No major financial shocks. Steady income. Predictable environment. The other grew up in uncertainty. Income instability. Unexpected losses. Economic crises. Now ask them both. Should you take financial risks? Their answers will differ dramatically. But both answers will be logical based on their life experiences. Because financial decisions are not made in classrooms. They are shaped by lived reality. The experience gap. Here's something rarely discussed. Your personal experience with money is incredibly small compared to history. If you're 30 years old, you've experienced maybe 1 or 2 economic cycles. But financial history spans hundreds of years. Your perception of normal is based on a tiny window of time. Yet your brain treats it as universal truth. If markets have mostly gone up during your investing years, you may believe declines are temporary and harmless. If markets crashed during your early investing years, you may believe they are dangerous and unstable. Same data, different conclusions, different experiences. Risk tolerance is personal. Financial experts often talk about risk tolerance, but they treat it like a number. High risk tolerance, low risk tolerance. In reality, risk tolerance is emotional memory. If you've never experienced deep loss, risk feels manageable. If you felt real financial pain, risk feels threatening. So when someone avoids investing, it may not be ignorance. It may be emotional protection. The invisible forces. Every financial decision is influenced by invisible forces. Culture, family values, religious beliefs, social pressure, economic history, political stability, education access. All of these shape perception. In some cultures, debt is normal. In others, debt is shameful. In some families, investing is encouraged. In others, it's considered gambling. If someone avoids stock markets, it may be because their environment taught them to distrust it, and that environment felt real to them. The role of environment. Behavior is often local. If everyone around you buys property, you believe property is the safest investment. If everyone around you trades stocks, you believe markets are the opportunity. If everyone around you struggles financially, you may prioritize immediate spending over long-term planning. Because when survival feels uncertain, the future feels distant. Short-term versus long-term thinking. People in unstable environments often focus on short-term survival. People in stable environments often think long-term. It's not about intelligence. It's about security. When basic needs feel threatened, long-term investing feels irrelevant. When stability exists, patience becomes possible. Security allows planning. Insecurity demands immediacy. The judgment trap. We often judge financial behavior without understanding context. We see someone living paycheck to paycheck and think they should budget better. But maybe they're supporting extended family. Maybe healthcare costs are unpredictable. Maybe job stability is uncertain. Maybe financial education was never available. Judgment is easy. Understanding is harder. But understanding reveals the truth. Everyone is responding rationally to their version of reality. The market bubble example. Think about financial bubbles. From the outside, bubbles look insane. People buying assets at ridiculous prices. Overconfidence. Excessive risk-taking. But during the bubble, it feels logical. Because everyone around you is participating. Media celebrates it. Neighbors profit from it. Friends discuss it daily. Human beings are social creatures. We feel safety in numbers. When everyone believes something, doubt feels uncomfortable. So people join. Not because they're crazy. Because they're human. The pain of being wrong alone. Being wrong with the crowd feels safer than being right alone. That's a psychological reality. So sometimes people follow trends, even if they suspect risk. Because social belonging reduces emotional discomfort. Finance is not just individual behavior. It is collective psychology. The danger of overconfidence. Sometimes people take extreme risks, not because they're foolish, but because past success created confidence. If someone made money repeatedly in rising markets, they may believe they have skill. But rising markets reward almost everyone. Success can blur the line between skill and luck. And when confidence grows, risk-taking grows, until reality intervenes. Survivorship bias. We often hear stories of people who became rich through bold risks. We rarely hear stories of those who failed. Because failure disappears quietly. Success becomes visible. This creates distorted perception. It makes risky behavior look more common and more successful than it actually is. So people imitate what they see, not realizing what they don't see. Personal finance is personal. The biggest mistake in money discussions is assuming one strategy fits everyone. But life circumstances vary dramatically. Income stability, health, dependence, opportunities, location. All of these influence decisions. So when someone chooses safety over growth, or growth over safety, they may be choosing based on their life structure, not ignorance. Emotional comfort is powerful. At the end of the day, people choose financial strategies they can emotionally tolerate. An aggressive strategy with high returns means nothing if you can't sleep at night. A conservative strategy with lower returns may be better if it brings peace. Peace allows consistency. Consistency allows compounding. And compounding builds wealth. The lesson of perspective. When you see someone make a financial decision you disagree with, Pause. Ask, what might their experiences be? What risks have they seen? What fears might they carry? Understanding context transforms judgment into empathy, and empathy leads to wisdom. Final reflection. Chapter 3. No one is crazy about money. People are shaped by their history, their environment, their trauma, their culture, their limited experience. We all operate with incomplete information. We all rely on personal experience. And we all believe our perspective is logical. Financial maturity begins when you accept this truth. When you stop assuming others are irrational and start recognizing that behavior makes sense from the inside. Because in the world of money, perspective is everything, and humility is a competitive advantage. Chapter 4. Luck and Risk. The invisible forces behind every fortune. When we look at success, we see skill. When we look at failure, we see mistakes. But rarely do we see something far more powerful. Luck. And its twin, risk. They're invisible forces, silent architects of outcomes. Yet we underestimate them constantly. The illusion of control. Human beings crave control. We want to believe that effort equals reward, that discipline guarantees success, that intelligence prevents failure, because that belief feels safe. But reality is more uncomfortable. Two people can work equally hard. One becomes wealthy, the other struggles. Why? Timing, opportunity, random events, external conditions, luck, and sometimes bad luck. The story of success. When someone becomes extremely wealthy, we create a story. They were brilliant. They worked harder. They saw what others couldn't. And sometimes that's true. But what we rarely analyze is, where were they born? Who did they meet? What era did they live in? What opportunities existed? The world rewards certain skills in certain periods. Someone born during a technology boom has different opportunities than someone born during economic collapse. Skill matters. But timing magnifies skill. The other side, silent failures. For every successful entrepreneur, there are hundreds who tried equally hard and failed. But we don't read their biographies. We don't interview them. We don't analyze their lessons. Because failure is invisible. This creates a distorted perception. We assume success stories represent pure skill. But we ignore how many similar stories ended differently. Risk, the hidden partner of luck. Luck is visible in success. Risk is visible in failure. But they're always present together. When someone wins big in the market, luck helped. When someone loses everything, risk materialized. But both existed from the beginning. The difference is timing. The problem with extreme examples. Society loves extreme examples. The billionaire who started from nothing. The investor who turned $10,000 into millions. But extreme outcomes often involve extreme luck. When we study only the extremes, we misunderstand the average reality. And average reality is where most people live. Survivor bias. Imagine a battlefield. If you only study the planes that returned safely, you miss the planes that never came back. This is survivor bias. In finance, we study winners. We copy their strategies. But we don't see those who used the same strategy and failed. This makes risky behavior appear safer than it truly is. The problem with extreme examples. Society loves extreme examples. The billionaire who started from nothing. the investor who turned $10,000 into millions. But extreme outcomes often involve extreme luck. When we study only the extremes, we misunderstand the average reality. And average reality is where most people live. Survivor bias. Imagine a battlefield. If you only study the planes that returned safely, you miss the planes that never came back. This is survivor bias. In finance, we study winners. We copy their strategies. But we don't see those who used the same strategy and failed. This makes risky behavior appear safer than it truly is. The humility principle. When you acknowledge luck, you become humble. When you acknowledge risk, you become cautious. This combination creates balance. Without humility, success creates arrogance. Without caution, confidence becomes recklessness. The danger of over-attributing skill. If someone succeeds and believes it was purely skill, they may increase risk. They may believe, I can't lose. I understand the system. I've mastered the market. But markets are unpredictable. Conditions change. What worked once may not work again. Ignoring luck leads to overconfidence. Overconfidence invites risk. And risk eventually tests belief. Personal life and luck. Luck isn't only in markets. It's in careers, relationships, health, location, meeting the right mentor, being born in a stable country, avoiding illness. All of these influence financial outcomes, but we rarely credit them because acknowledging luck reduces ego, and ego resists that. Compassion through understanding. When you understand luck and risk, you become less judgmental. You stop assuming success equals superiority. You stop assuming failure equals incompetence. You see life as a complex interaction of effort and randomness. This perspective creates empathy, and empathy leads to wiser decisions. The margin of safety. If luck plays a role, and risk is always present, what should you do? Build a margin of safety. Don't assume the best outcome. Don't rely on perfect conditions. Prepare for uncertainty, because the future will surprise you. It always does. Long-term thinking. Luck may create short-term spikes, but long-term survival requires discipline. The goal isn't to maximize every opportunity. It's to stay in the game, because time smooths randomness, and survival allows compounding, avoiding the ruin scenario. In finance, there is one outcome worse than slow growth. Ruin. Complete loss. Game over. You can recover from small losses. You cannot recover from total destruction. So the smartest strategy is not maximizing gain. It's avoiding ruin. Emotional impact of luck. When luck benefits you, gratitude creates humility. When bad luck harms you, resilience creates strength. Both are necessary. But blaming yourself for every negative outcome, or crediting yourself for every positive one, creates distortion. Balance comes from acknowledging both forces. The long arc of fortune. Over a lifetime, luck and risk balance out more than we realize. Not perfectly, but more than daily news suggests. Short-term events feel dramatic. Long-term trends are smoother. That's why patience matters. Because luck's impact fades over time, and behavior's impact grows. Final reflection. Chapter 4. Luck and risk are invisible partners in every financial story. You cannot eliminate them. You cannot predict them perfectly, but you can respect them. Respecting luck keeps you humble. Respecting risk keeps you cautious. Together, they create wisdom. And wisdom, not brilliance, is what builds lasting wealth. Chapter 5. Never Enough. The Dangerous Illusion of More. There is a silent force that has destroyed fortunes, broken families, collapsed empires, and ruined individuals who already had everything. It is not poverty. It is not bad luck. It is not lack of intelligence. It is the belief that more is always better. The belief that what you have is never enough. The moving goalpost. Imagine achieving your financial goal. You wanted to earn $1 million. You reach it. For a brief moment, you feel satisfaction. Then a new thought appears. What about $2 million? The goalpost moves. It always moves. This is human nature. Psychologists call it adaptation. We adjust quickly to improvement. Yesterday's dream becomes today's normal, and tomorrow's dissatisfaction. The comparison trap. Enough is rarely defined internally. It is defined socially. You don't compare your wealth to your past self. You compare it to others. Neighbors, colleagues, friends, social media. And there will always be someone with more. This creates an endless race. A race with no finish line. Because someone will always be ahead. The billionaire paradox. Some of the wealthiest individuals in history continued taking extreme risks, even after achieving unimaginable wealth. Why? Because for some people, money stops being about comfort. It becomes about scorekeeping. And in scorekeeping games, there is no enough. Only higher numbers. But numbers without purpose become dangerous. When success turns into risk. Imagine you have $100 million. You could live comfortably for generations. But instead of protecting it, you risk everything for more. Why? Because stopping feels like losing. Because maintaining feels boring. Because growth feels exciting. This is the psychological trap. When accumulation becomes identity, and identity demands constant increase. The danger of ego. Money can quietly feed ego. It can create a sense of superiority, control, status. And ego hates limits. Ego resists the word enough. It whispers, you deserve more. You can handle more risk. You're smarter than others. But markets don't care about ego. Reality doesn't negotiate with pride. The story of ruin. History is filled with examples of individuals who had extraordinary wealth and lost it all. Not because they needed more, but because they wanted more. They crossed the line from ambition into excess, and excess invites vulnerability. The psychological cost of more. Chasing more has hidden costs. Stress, anxiety, paranoia, constant pressure. When your lifestyle expands with your income, you become trapped. High expenses require high income. High income requires high pressure. And pressure reduces freedom. Ironically, the pursuit of more can reduce the very freedom money was meant to create. Enough is a decision. Here's a powerful truth. Enough is not a number. It is a choice. Two people can have the same income. One feels wealthy. The other feels behind. Why? Because one decided what enough means, and the other didn't. If you never define enough, you will always feel lacking. Freedom versus status. Money can buy two main things: freedom or status. Freedom means control over your time, Status means recognition from others. Status is expensive, and it never satisfies permanently. Freedom is quieter, less visible, but more fulfilling. Choosing between these two paths shapes your life. The risk of comparison. Social comparison didn't evolve for modern society. It evolved in small tribes. Comparing yourself to 5 people was manageable. Now we compare ourselves to millions online. The richest, the most successful, the most visible. This creates distorted perception. You see the top 1% constantly, and forget the average reality. This fuels dissatisfaction, even when you're doing well. Wealth versus wealthy appearance. Real wealth is what you don't see. Savings, investments, assets quietly compounding. Wealthy appearance is what you do see. Luxury cars, designer brands, expensive homes. But appearances are often financed. Real wealth is often invisible, and invisible wealth rarely competes for attention. The happiness curve. Research shows something interesting. After basic needs and moderate comfort are met, happiness does not increase proportionally with income. But stress often does, because higher wealth often brings complexity, responsibility, public scrutiny, security concerns. More is not automatically better. It depends on what you value. The calm of contentment. There is immense power in contentment. Not complacency. Not laziness. Contentment. The ability to say, "This is enough for my life." It creates peace. It reduces risk-taking for ego. It allows long-term thinking. It protects what you've built. The trap of endless ambition. Ambition is valuable. It drives progress. It fuels innovation. But ambition without boundaries becomes destructive. If growth becomes obsession, you sacrifice balance. Relationships, health, peace. Financial success that destroys personal well-being is not success. Long-term security. Those who define enough often protect their wealth better because they're not constantly chasing. They avoid unnecessary risks. They preserve capital. They allow compounding to work. And over time, they often end up wealthier than those who chased endlessly. Ironically, contentment can outperform greed. The question that changes everything. Ask yourself, what is enough for me? Not for society. Not for comparison. For you. What lifestyle brings peace? What income supports your values? What level of savings makes you feel secure? Write it down. Define it. Because undefined goals create endless pursuit. Final reflection. Chapter 5. The greatest financial risk is not market volatility. It is the inability to say enough. When more becomes the goal without purpose, risk increases. Stress increases. Peace decreases. But when you define enough, you gain clarity. You protect what matters. And you align money with meaning. Because in the end, wealth without boundaries is fragile. But wealth guided by contentment is powerful. Chapter 6. Compounding. The quiet superpower of time. There is a force in finance. So powerful. So reliable. So quietly transformative. That it can turn ordinary behavior into extraordinary wealth. It doesn't require genius. It doesn't require perfect timing. It doesn't require constant action. It requires one thing: time. And when time meets consistency, you get compounding. The magic that looks boring, Compounding is simple. You earn returns on your money. Then you earn returns on those returns. Then those returns generate even more returns. And slowly, growth accelerates. But here's the paradox. Compounding looks unimpressive in the beginning. In fact, it looks almost pointless. Year 1, small growth. Year 2, slightly more. Year 3, still modest. Nothing dramatic. Nothing exciting. Which is why most people quit too early. The curve that changes everything. Imagine drawing a line on paper. For many years, it moves upward gently, almost flat. Then suddenly, it curves sharply upward. That's compounding. The dramatic part happens at the end. But the foundation was built in the quiet years. Most people want the curve. Few are willing to wait for it. Time is the multiplier. Money invested for 40 years grows exponentially more than money invested for 10. Not because of higher intelligence, but because of time exposure. Time is the most powerful multiplier in finance. Even small returns become large, if given enough time. But time demands patience. And patience is emotionally difficult. The psychological challenge. Compounding is mathematically powerful, but psychologically demanding. Because humans crave immediate results. We want visible progress, quick wins, fast returns. Compounding offers none of that in the beginning. It offers boredom, routine, consistency, and delayed gratification. Which is why it works. Because few people stick with it. The story of long-term wealth. Many of the world's greatest fortunes were not built overnight. They were built steadily, over decades, reinvesting profits, avoiding catastrophic loss, allowing time to work. The secret was not extraordinary returns. It was extraordinary duration. The power of staying invested. Markets rise and fall. News headlines create fear. Volatility shakes confidence. The temptation to react is strong. But compounding only works if you remain invested. If you constantly enter and exit, you interrupt growth. You reset momentum. Consistency beats activity. Stillness often beats movement. Small habits, big outcomes. Compounding is not only financial. It applies to behavior. Saving a small percentage regularly. Investing monthly. Avoiding unnecessary debt. Improving financial discipline slightly each year. These small habits accumulate. Just like money. Just like interest. And over time, they produce transformation. The danger of interruptions. Compounding has one enemy. Ruin. If you lose everything, time resets to zero. That's why avoiding catastrophic risk is crucial. You don't need to maximize gains. You need to avoid destruction. Because compounding needs survival. And survival requires discipline. Why early start matters. Starting early is not about higher income. It's about longer duration. Someone who invests modestly at 25 often ends up wealthier than someone who invests aggressively at 40. Because time is more powerful than intensity. Early years matter more than large contributions later. Time cannot be recovered, but it can be maximized. The emotional reward. The beauty of compounding is that it reduces stress. You don't need to chase trends. You don't need constant predictions. You don't need dramatic strategies. You need consistency, patience, emotional stability, and faith in long-term growth. It transforms finance from chaos into calm progression. The snowball effect. Imagine rolling a small snowball down a hill. At first, it barely grows. But as it continues, it gathers more snow, more momentum, more size. Eventually, it becomes massive. But only because it kept rolling. If it stopped halfway, it would remain small. Your investments are the same. Momentum requires motion over time. Compounding versus excitement. Excitement sells. Compounding builds. Exciting investments create headlines. Compounding creates quiet wealth. Excitement feeds ego. Compounding feeds stability. The challenge is choosing long-term progress over short-term thrill. Time rewards discipline. Compounding does not reward intelligence alone. It rewards behavior. The investor who avoids panic during crashes. The saver who continues during downturns. The person who resists lifestyle inflation. Time amplifies disciplined behavior and exposes reckless behavior. The hidden advantage. Here's something powerful. You don't need extraordinary returns to become wealthy. You need ordinary returns for extraordinary time. That's the secret. Not 50% annual gains, but 8 to 10% sustained over decades. That is enough, if you allow it to work. The cost of impatience. Impatience destroys compounding. Chasing hot trends. Switching strategies frequently. Selling during fear. Increasing risk for quick gains. These behaviors interrupt growth. They sacrifice long-term multiplication for short-term stimulation. And short-term stimulation is expensive. The quiet confidence. Those who understand compounding develop calm confidence. They don't react to every headline. They don't obsess over daily fluctuations. They zoom out. They trust time. And trust creates emotional stability, which protects long-term growth. The true wealth builder. Compounding is not glamorous. It doesn't impress at dinner conversations. It doesn't create viral stories. But it quietly transforms ordinary savers into financially secure individuals. It rewards humility, patience, consistency, and self-control. Final reflection. Chapter 6. Compounding is the quiet superpower of wealth. It does not shout. It does not rush. It does not demand brilliance. It demands time and discipline. In a world obsessed with speed, compounding rewards patience. In a world addicted to excitement, compounding rewards boredom. And in a world chasing shortcuts, compounding proves that the slow path is often the strongest path. Because when time works for you, you no longer need to chase money. Money begins to grow on its own. Money is not just numbers. It is behavior. It is patience. It is discipline. It is self-awareness. If you've listened this far, you already understand something most people never do. Wealth is built quietly, through psychology, through consistency, through time. And this journey is only getting started. In the next chapters, we'll uncover how to stay wealthy after you earn it, why survival matters more than brilliance, how freedom becomes the ultimate currency, and how mastering your emotions gives you financial power. So, if you're serious about mastering money, not just earning it, but understanding it, backhand index pointing right, subscribe now. Backhand index pointing right, turn on notifications. Backhand index pointing right, comment below. I choose long-term wealth. Backhand index pointing right, and share this with someone who needs financial clarity. Because the future of your wealth is not decided by the market. It's decided by your mindset. And your mindset starts today.